Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. It's important to understand the risks with any business or any investment, and that's why I want to go over 3 risks or red flags with Tesla right now. Not everything is going really well for the company. In fact, there are some major red flags that I have seen over the last 6 months that continue to get worse. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you like this video, check out my newsletter, Asymmetric Investing, in the show notes. The first thing that I want to highlight is the price cuts that Tesla is making and its impact on margins. You can see from this chart that margins have dropped dramatically over a little bit more than a year. In the first quarter of 2022, margins, when you exclude regulatory credits, peaked at 28.8. In the most recent quarter, the margin was 17.9%. So more than a 10% drop in margins. And the biggest reason for that is the company is cutting prices. We've seen that pretty consistently over the last 8 or 9 months, is that Tesla continues to reduce prices, started doing those discounts in late 2022. Those accelerated in 2023, and the most recent cuts were to the Model S and Model X. Those were price cuts that were in excess of 20% in sometimes. And they've even cut the price of full self-driving. So what that would indicate typically is if a company is being forced to cut prices, it's because there's not enough demand for the supply that they have in the market. And this is a dynamic that I think brings up the second red flag, which is the company's expansion plans. Elon Musk has repeated over and over that he wants Tesla to grow production about 50% per year. That involves building massive new manufacturing plants all over the world. The next one up is supposed to be in Mexico, but they have been reportedly hitting some delays in Mexico. This plant should be under construction right now, with production expected to be Q1 2025. But recent reports have said that that may be pushed back to being in construction as late as 2027. So 2026, 2027 is potentially the time that they're actually going to be beginning construction, with production potentially to follow about a year or so later. The challenge is, if Tesla isn't going to be building manufacturing plants as quickly as we once thought, they're not going to be able to ramp up that vehicle production as quickly as they thought and grow revenue. Now, this will actually help margins because you won't have as much supply in the market. Tesla is priced as a growth stock, so you have to not only grow revenue, but also do it at a high margin. This is really the delicate balance that Tesla is playing right now, given its current valuation. So depending on how you're looking at Tesla as a company, it can be a major red flag if they're not going to be growing production nearly as quickly as we thought, even just a few months ago. And the final thing to talk about is inventory. Tesla's inventory has exploded over the last year. In the last 4 quarters, the company has produced 88,000 more vehicles than it has sold. Now, this wouldn't normally be a problem, especially for a growth company. You would expect inventory to grow as revenue grows, but inventory is growing more quickly than revenue. Tesla is one of the rare companies that actually has to hold that inventory on its balance sheet because it doesn't have dealers the way that a lot of other automakers do. And on top of that, this is not a problem that we have seen previously at Tesla. In the 4 years prior to the most recent 4 quarters, Tesla was essentially flat if you look at production of vehicles and delivery of vehicles. So that is something that has changed in a dramatic way just over the last 12 months. Now you add these 3 things together: falling margins, problems expanding production, and rising inventory. And the story that it tells is that Tesla does not have the pricing power that it used to, which makes a lot of sense because the company is going to produce nearly 2 million vehicles this year. They're expecting to continue to grow that, and they don't have a lot of models. The Cybertruck is still not out, and that would really be only the 3rd platform that the company is building. So there's just not that much demand for one specific kind of vehicle. Doesn't meet everybody's needs, and the price point, at least until recently, has been relatively high. But these factors will impact Tesla's margins and profitability. We have already seen that over the last 2 quarters, that margins are coming down dramatically, free cash flow is coming down, and I think that trend will continue in 2023. What do you think? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.